Good morning and welcome to Beacon Point's Manager Insights webinar series. My name is Jason Overholzer and I lead Equity Manager Research here at Beacon Point. Today, our discussion will be a market and strategy update featuring Alison Shimada of Wells Fargo Asset Management. Alison is a senior portfolio manager and head of global emerging markets for the San Francisco-based team. After posting strong returns in 2017, emerging markets have faced increased volatility this year due to uncertainty in Turkey, trade war concerns, and other factors. Given the increased volatility, we thought it would be timely to have Wells Fargo review their thoughts on the market and discuss some of the themes they're seeing today. Alison will also address how her team is navigating these markets on behalf of our clients invested in the strategy. Thank you again for joining us, and with that, I'll hand it over to you, Alison.
Thank you, Jason. Thank you, everyone, for listening to this. I think it's very timely to be talking about emerging markets. And I'm going to start with the presentation on page 2 to talk a few points, speak a little bit about the asset class as a whole. I would say year to date, the asset class has suffered from some redemptions. We had a lot of money coming in last year and a half in 2017 and part of 2016, but we have seen redemptions out of the asset class as a whole. And I think people are particularly nervous about all the events that have occurred, not only in emerging, but in the markets overall. As you can see there, the first point, emerging markets net index decline for the past 5 consecutive months and has generated, but still generated positive 1-year return. And the main contributor there would have been IT. And this is true globally. It just follows along from the so-called FANG stocks that particularly Chinese internet stocks have been highlighted, and it has been very narrow market leadership over the last year. And I think that's a particularly important point. This has not been a broad rally, particularly in 2017. It really was led by one sector, and that's very, very unusual. But we have had very strong returns from IT globally, so emerging markets participated in that. In terms of market leadership on page 3, you can see that to this point, once again, and over the 1-year period, or whether that be 2017, and even going back to 2016, you have seen the emergence of very strong returns and a very strong contribution from certain names only. And really what it comes down to has been 3 or 4 names in emerging markets, such as Tencent, Alibaba, etc., Baidu. And for good reason. These are very important companies within emerging markets, within China. The government of China has a very strong interest in cultivating very strong market leaders in this area because they realize technology will be important to managing the economy going forward. So they'll have let them become very large companies. In terms of dividend yield, this is the way we manage our portfolio, as illustrated on page 4, that what you've seen, if you think about dividend yield in the quintiles, the top quintile being the highest dividend yield and quintile 5 being the lowest, those companies that are in quintile 5 that had the strongest returns over the last year, as you can see with the highest blue bar there, 18.4%. And if you think about dividends, they haven't been much in focus. Why is that? The reason for that is that we've been in a rising interest rate cycle, and therefore, in that case, people will focus more on growth stocks than they will on dividend yield. But that does not mean dividend yield is irrelevant. So, if you think about the longer term aspect of dividend yield, it's been additive to returns in every asset class, the U.S. being one over the very long term, EAFE, including Japan, and emerging markets. So as a strategy and as a way to manage money in emerging markets, we feel it's still a very strong framework. And the reason being that 30 to 40% of your total return still comes from dividend yield, and the companies that we invest in at least are very strong payers. So, and we expect that in the future, dividend yield will continue to be a strong component of shareholder returns, and that thesis will not change. Over the very short term, it has not particularly worked over the last year, but you know what? The actual strategy has performed as we would have expected. So as this leadership in emerging markets broadens out to more sectors other than IT, where there's very little in terms of internet, there's very little dividend yield to be found that meet our requirement, that as industrials, financials, healthcare, other sectors participate more in the, in growth, that we will find dividend yield there as well. So we are very confident that this is a very strong framework. As you can see, the recent events on page 5 show that we did have quite a nice run here in emerging markets, and things have come off a bit in 2018. In 2018, there have been a series of presidential elections. There's Brazilian trucker strike, as Jason mentioned. We've had other things, Turkey most recently going on. I think, though, the bottom line is people have made a lot of money, and it really comes down to thinking of reason to take a little bit of money and trimming back their positions and the winners that they've had. Some of the stocks that not only internet, but the other Chinese A shares and other various types of shares in emerging have, some of them gone up 50 to 100%. So it's natural that people would want to take money off the table. And not only that, there's some concern about trade wars and the influence that President Trump has over the global markets and what he will say next and do. So people are, I think, in generally trying to take money where they have made money. On page 6, dividend yield factor is important in the sense that we talked about the quintiles of dividend, that the first and second are really the areas that we invest in most heavily in this strategy, and 5 would be where we do not participate. And if you can see that the dividend yield combined with earnings is a very important combination to look at and the best area longer term to invest in. And we feel that as we see a broadening of support for emerging markets, and we feel that right now, with the markets having sold off some, we see extremely good value in certain areas. So we are very encouraged by that. We will be looking to invest more money in areas that we like, countries that we like. And we see it somewhat across the board, but mostly in Asia. And we see, I think, opportunities in China. We see opportunities in Taiwan and Korea. We also see opportunities in the ASEAN countries, some of which are areas like Malaysia and Thailand. On page 7, you see the portfolio positioning, and it is the top 10 on the upper left side is dominated by quite large companies. And 2 themes that we've seen this year in emerging markets have been energy and materials, and so we are quite well weighted in those 2 areas. And we are also taking some profit, as I said, but reinvesting those in areas that are either feel have been oversold and therefore are undervalued stocks, and the dividend yield indicates when it's higher than it has been historically for particular companies. For instance, a company that normally has a 3% dividend yield now has a 6% dividend yield. It's time to take a look at it. And that's what we're looking for now and talking about in our team. And on the upper right side, the portfolio characteristics, I'd like to point out a few important things about investing with dividend yield. Number 1, it always consistently gives you lower than average standard deviation. So standard deviation is a measure of risk in the market. It's always consistently lower. And also you'll see us with a slightly lower average weighted market cap to that of the benchmark, because what's really worked over the last 12 months have been the very large cap companies like the internet companies that have, 100 billion, 200 billion in terms of market cap. That has driven up the benchmark weight. What we like to invest in are between 1 to 10 billion USD market cap, but also we've invested, as you can see in the top 10, in large companies as well. And we try to invest across the board in terms of sectors and across the board in terms of countries. There are 24 countries in emerging markets, of which China is by far the largest, and we are very, very constructive on the future of China. And what we're trying to do in the midst of all of this noise about trade wars, et cetera, is trying to manage through that, to think about, the 2 to 5 year time frame and what is going to be in focus at that point. But because oftentimes with large stocks, we will hold them for more than a year or 2. We will hold them continuously. So we're trying to manage through this and see what is actually a strong company in terms of cash flow, in terms of the business model, in terms of their positioning in the country, and invest in those companies and countries at a lower valuation that we normally have, because we have an opportunity now here mid-year, especially before the start of Q4. This is my point earlier on page 8 about standard deviation, that it really helps to invest with dividend yield. And emerging markets, as an average, has a standard deviation of 80%. The income strategy has a standard deviation, 80% of that of the index. So it really does help you. And I point out also we're in the kind of late stages of a very long expansion in markets. And when that happens, you do not want to invest in an asset class like EM without some downside protection. And I think that that is why it's particularly relevant to think about dividend yield now, because you still can participate in the market. And half of the attraction of this type of strategy is the dividend factors of dividend yield, or the characteristics of dividend, but also the other half is stock selection. And for a team that we have with over 20 years of experience on average, we have invested with dividend yield over the last 10 years. We do know what to buy in this type of market. And also another point would be on page 9, that dividends provide diversification. This provides uncorrelated return to those of other strategies. This is just an example here, but at the top, the average correlation of excess return is very low at 0.1 to other types of strategies one could own. So oftentimes this is coupled with a higher growth strategy by some investors, or it can be a standalone exposure to emerging markets. But emerging markets is no longer a sort of sideshow to think developed markets. It will become very significant in the future, and it is, I think, very relevant to own at least some exposure to emerging markets and to buy it when it has sold off, which is right now. And page 10, dividends are a significant portion of total return, as I mentioned earlier. And this is true not only for this asset class, but for all asset classes, because dividends act the same way everywhere. But dividends are paid very regularly in emerging markets, and local investors also expect dividends. And they're mostly cash dividends that are paid. And they also feel that this is, they invest with dividend yield. So you're investing alongside local investors, and we often try to buy local shares in the local markets. And so we feel that it's a win-win situation, because governments will also want the companies to pay dividends because it makes for better corporate governance, and they want to keep foreign shareholders happy in their country. So I'd say on page 11, the market outlook, emerging markets has, at this point in time, we feel there are a lot of opportunities starting to surface here. I think as an entry point, it's very important. I also think it's as a framework that emerging markets equity income is an important way of staying in the asset class, because what I'd like to emphasize is that people often ask us, how do you get in and when do you get in and out of emerging markets? That's not the point. The point is that this is a long-term strategy for which it allows you to stay in the asset class, because timing of the asset class is very difficult. And so, you're paid to wait for the returns, and our average dividend yield on the portfolio forward 12 months is approximately 4.5% versus the index, which is about 2.6 right now. So it usually ranges between 4 to 5%. We're also looking for companies with EPS growth of approximately 10 to 15 to 20% at this point. So, if the companies perform, there's a re-rating on the stock, plus you get a dividend yield. That's the best way, in our opinion, in terms of holding on and lasting through a lot of noise that we're having this year and many years. Every year there's noise. But the bottom line about emerging markets is that the long-term perspective of emerging is very promising. Half of the world's consumption over the next 20 years will come from emerging markets. You're seeing more and more people moving into the middle class. In countries like India and China, millennials, as we always often talk about them, can number 400 to 600 million people. That's so influential. And not only that, government policy, emerging markets, some of these countries, some of them have fallen a populist bent. Turkey is one. There's always issues there. And we've seen other countries, Mexico slightly, Brazil, tending to move towards populism for the time being. It's a worldwide phenomenon and kind of a reaction to globalization. But there are countries emerging like China, which are going to provide very important leadership globally. And it's very difficult to ignore 30% of the whole entire asset classes from one particular country. So we will be there investing, and we have local expertise to do that. So we really feel that, dividend yield has, as we've gone up and the U.S. Treasuries are approaching 3-4%, the people will start to think again about dividends. So, we think it's a great time. And we look forward over the remainder of the summer to look to invest further, and also opportunistically look at some names whose dividend yields were sometimes too low for us to invest. It gives us a good opportunity to get into some new names as well. So that's the end of the presentation, and I'll turn it back over to Jason.
Great. Thank you, Alison, for sharing your thoughts with us today. I believe your presentation gave our attendees some great insight on the factors driving the markets today and how your portfolio is positioned. Thank you to all of our clients for listening in. Please don't hesitate to reach out if you have any questions at all on the Wells Fargo strategy or on the markets in general. You can also send an email to our BPA webinar at beaconpoint.com email address, and we'll make sure to address any questions that you might have. We hope to see you at our next Manager Insights webinar. Have a great day.